The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.
For millions of Americans who retire every year, the task of ensuring that your money is working hard enough to provide you with a consistent paycheck can make the job of working for that paycheck seem easy. Retirement doesn't signal the end of financial worry. In fact, for the majority of retirees, it's just the beginning. The assets you have built must be able to provide you and your family with financial security for all the years to come. That's why you need a game plan for retirement, making sure you have a plan and that your money is working hard to provide you with an income you can depend on. This is your game plan for retirement.
And welcome into Your Game Plan for Retirement, the show that challenges some of the traditional financial planning concepts and models and outdated conventional Wall Street wisdom on building for financial success. We talk about the income allocation model that has proven to provide for more financial freedom throughout your retirement. We always check in with your local income allocation coach from northern Pennsylvania, from Allentown to the Poconos and the Lehigh Valley. For a retirement built to last, we turn to ASC founder and president Ralph Grauso. Ralph, welcome into Your Game Plan for Retirement.
Peter, good morning. It's great to be back with you.
Always a pleasure having you on the program, sir, sharing your time as well as your knowledge and your expertise with us and the listeners here on Your Game Plan for Retirement. And I want to remind the listeners that if they do have questions of their own, if you would like to get in touch with Ralph Grauso and the team from ASC Financial, they're just a phone call away. 800-939-8633 is the number to call. 800-939-8633. And Ralph, our topic for today's program is sequence risk. Sequence risk is something that is a relatively new concept that we're hearing in the financial world. Is sequence risk, in fact, a new thing, or why have we not heard this term before?
Yeah, sequence risk has always been there, Peter. It's a risk. It's probably one of the most devastating risks that a retiree will face. But here's the caveat, Peter, if they need income. So if you're taking income out of your investments, this is where sequence risk comes into play here. Because what you're going to see with sequence risk, it's not the return on your investment, it's the sequence of return on your investment. What we mean by that is you get early losses based on the stock market. Those early losses can devastate someone's retirement over a long period of time.
So when you say in sources that rely on the stock market, you're not talking about sources such as pensions or Social Securities. Those would not be affected by sequence risk.
Exactly. We're looking at accounts that are variable, that are based on the performance of the stock market, i.e. stocks, bonds, mutual funds, any type of investment that's going to be based on the performance of the stock market in general. Sequence risk is going to have a play on that. But if you're receiving a pension, Social Security, these are forms of guaranteed income, and guaranteed income sequence risk does not affect those type of accounts.
And Ralph, as was discussed in the book that you contributed to, Income Allocation, those sources of retirement income, such as pensions and Social Security, those are really what we should be basing our foundation on anyway, and therefore isolating ourselves from sequence risk.
Yeah, except the problem, Peter, is that many people today are retiring without a pension. You know, they're retiring with a 401k. And the majority of these 401ks are invested in the market. They're invested in mutual funds. And so there's no plan in that 401k to distribute income on a guaranteed basis like a pension. That becomes the issue.
And the fact that the market has seemingly grown much more volatile over the last 10 to 15 to 20 years, has that actually increased the effects and amplified the risk of sequence risk?
Well, sure it will, Peter, because every time the market goes down and I'm taking money out of my account, I'm basically getting a double hit. So if, let's say, I'm taking 5% of my account out in the form of income, I have $100,000, I'm taking $5,000 out, and now I lose 10% of the value of that account at the same time, I'm now down 15%, and that becomes the issue.
So basically what we have been told along the way, that the dips in the market and that the market always comes back and to just keep investing, that actually has changed, must change for us in retirement. What you're basically talking about is the effects of dollar cost averaging in reverse.
Exactly, Peter. It's dollar cost averaging in reverse. So Peter, another way to take a look at this is many pundits out there, Wall Street people will say to you that you invest your money in the market, put it into a S&P 500 index fund like with Vanguard or Fidelity, and it's just going to mirror the performance of the S&P. So the S&P goes up, you're going up. The S&P goes down, you're going down. They'll tell you not to take out any more than 4%. That's the magic number for withdrawals. And you can increase that each year by 3% to keep pace with inflation. So we have a gentleman back in 1996 that retires with $1 million. And he puts that money into an S&P 500 index fund, and he takes out his 4%. So he'd take $40,000 out the first year. He increases it the next year by 3%. So he takes out $41,500, and so on. At the end of 2015, based on the performance of the S&P, what would have happened is at that point, what's left in his account after he took his income out, his value of his account would be worth about $1.4 million. So another $400,000 on top of the million he started with, and took out about $800,000 over that period of time. So that would seem to work, except that another gentleman in 99 does exactly the same thing. The difference, though, is 1999 instead of 1996. And his $1 million is invested in the same account, S&P 500 index, and he takes out his same 4%, increases it by 3%. Now, this gentleman at the end of 2015 would only have about $200,000 of his $1 million left in the account, and he will now be running out of money. So the question is why did the gentleman from 96 have $1.4 million, and the gentleman from 99 in the same account, same withdrawal, only has $200,000, and that is what's called sequence risk. Because if you remember back in 96, 97, 98, 99, the S&P went up those years before we had our first major correction in 2000. The person retiring in 99, he now gets in, and now we have losses in 2000, in 01, in 02. And so those early losses totally devastated his plan. And so the bottom line with sequence risk, again, it's not the return of your investment, it's the sequence of return. And if you get negative losses in the early years of withdrawals from a plan, this will totally devastate that plan. And another way to look at it is the next 3 years, Peter, can determine the next 30 years of someone's retirement.
Well, folks, if you have a concern with sequence risk and how the returns of the market might affect your ability to be able to rely on stable income and rely on your portfolio to produce the necessary income for your standard of living, you need to give the team from ASC Financial Group, Ralph and Josiah Grauso, a call. They are your local income allocation coaches. They can be reached at 800-939-8633. Again, that number, 800-939-8633. And Ralph, I do have to imagine that with your motto, a retirement built to last, that you have methodologies, you have strategies that can help people overcome this sequence risk to their portfolio.
Peter, when we sit down with somebody, we take a real close look at this sequence risk. And for our clients and folks that come to see us that need income, require income over and above Social Security or over and above their pensions, we need to take a look at some strategies that are going to provide predictable, guaranteed income. And there are strategies out there that'll do just that.
Ralph, you mentioned that you're not seeing as many people with pensions anymore. And I'm sure in your decades of experience in financial services, this is something that has evolved because we are seeing more and more people now rely and have their retirement savings in assets such as the 401k, rather than the prevalence of pensions. Has the decrease or the death of pensions increased the prevalence of this sequence risk to retirement in your point of view?
The number one concern of most of the folks that come to see us, their number one concern is running out of money, not having enough income to last their retirement. And when we look at life expectancies right now, if I've got a married couple around the age of 65, one of them has a very strong possibility of celebrating their 90th birthday. We've got a plan for a 30-year retirement. And with folks that are retiring with a 401k, they might have accumulated $250,000 or $500,000 or $800,000 or $1.5 million. They might have that type of money, but how does that correlate to income, predictable income over that period of time? And so if they continue in variable accounts, i.e. mutual funds and stocks, those type of accounts, and they get some losses in these next couple of years, a likelihood of running out of money becomes more and more apparent.
Well, Ralph, you mentioned that sequence risk is very important in the early years of retirement, and I understand why a few negative returns in the early years especially can be detrimental, but couldn't sequence risk truly happen at any point in time? It sounds to me like it's affecting your retirement trajectory, and if the next several years are positive years, then we're in better shape. If the next several years are negative years, then obviously we're in worse shape. But couldn't this still happen maybe 5 to 10 years into retirement? It still affects the trajectory, doesn't it?
It always does. You're absolutely right there. The sequence of your returns. I mean, let's look at it this way, Peter. If I've got $100,000 and I lose 50%, I've got $50,000. And then it goes back up 50%, I have $75,000. And then if I'm taking income out and I'm taking money out, that's even more of a hit on that account. And so without income, it would take a double return just to get even. And then when we add income to that, it even makes the situation more dire. And so at any point in time, sequence risk is going to affect us. I think for our listeners out there, you need to understand, are you incurring sequence risk? And that is the bottom line. And if you are, then we need to address that and look at some alternatives, some solutions that are going to take sequence risk off the table.
Well, Ralph, I know that sequence risk was one of the topics that was written about in the book that you contributed to, Income Allocation, which really was talking about the new models for building retirement stability and security, and discussed some of the outdated conventional wisdoms of Wall Street and why they're just not working for today's retiree. And sequence risk obviously is one of those big reasons why the Wall Street model is not working for a more secure retirement. And I know in past shows you have given an offer for that book. Is that book something that you are, again, on this program willing to make an offer to give away to the listeners?
Peter, the only caveat I'm going to make is that the listener must be at least 50 years or older. But yes, absolutely. For anyone that would like a copy of this book, we would love to send it out to you. No obligation, no cost. I think you'll find it very informative.
And again, this book is about the power and the freedom in retirement created by reliable streams of income, folks. It is the new model for retirement security, the income allocation model. And it can be used to complement your growth assets and your asset allocation, but it should not be overlooked the necessity to have your income taken care of into and through retirement. That's what this book is all about. If you are 50 years of age or older, preparing for or already in retirement, you can receive a copy of this book free at no charge. The book is Income Allocation. All you have to do to receive your copy is pick up the phone right now and give a call to ASC Financial Group at 800-939-8633. Again, if you would like a copy of Income Allocation, pick up your phone right now, 800-939-8633. And Ralph, I guess as you alluded to there, sequence risk is actually compounded by the need for stable income. In other words, if we are pulling money out of our accounts to pay our bills, sequence risk is going to be even more of a factor that affects our long-term retirement trajectory.
Yes, that's correct, Peter. And the other thing we have to take a look at is what couples sequence risk is longevity risk. And what we mean by that is the longer we live, the more impact sequence risk is going to have on our plan. So we've got to look at solutions, again, that are going to take the sequence risk and this longevity risk off the table. And one of the ways to do that is by setting up predictable, guaranteed income that one can never outlive and will be paid to them over their entire lifetime.
In other words, Ralph, if we only live 5 or 10 years, the market being volatile may not have a great effect on our retirement savings and our ability to rely on our savings to produce income. And that's where maybe 2 generations ago is that they didn't tend to live a great long time once they had retired. But today's retirees are living longer and longer, which on the surface level, Ralph, that seems to be a good thing. However, because of what you're talking about here, sequence risk, that longer lifetime, if we have volatile markets, can be more affected by sequence risk.
That's right. Again, if someone retires and their retirement years are only 4 or 5 years, they pass away, there's really no concern. So what we see is that longevity risk is a multiplier of other risks that are involved, whether it be the chances of going into a nursing home or sequence risk. Those are the issues that we need to be addressing.
Well, on average, we tend to see a market correction every 5 to 7 years. So if we do have a 25 or 30-year retirement period here, Ralph, we might have the effects of sequence risk upon our portfolio, not just once, not just at the beginning of retirement, but several times in retirement.
Well, let's take a look at if someone, again, retired in 99. We had the market correction of 2001, 2002. The market rebounded, and people said, you know what, I stayed in and I got my money back. And then what happened? It happened again in 2008 to 2009. And we've been on sort of a bull run since that period of time. But as most of my clients will agree, whatever goes up is coming down, Peter.
Well, you mentioned those time periods, 2001 and 2002, 2008 and 2009. And the thing that strikes me and comes to mind is that those were the periods where the market went down, but it didn't make a full recovery until years later, 4 to 5 years later. From 2008, I think the market didn't come back fully until about 2012, and that's for people who weren't taking money out of their accounts. Sequence risk isn't just for that finite 2-year period where it was going down. It continued to plague people who were creating income for years thereafter, didn't it?
Exactly. Again, it's a devastating effect. Sequence risk, Peter, is probably the most devastating risk that a retiree faces, and it's really not being addressed out there. It's not being talked about from this point of view.
Well, you're talking about it in terms of long-term. Could sequence risk also be something that is more short-term? And what comes to mind there is the recent Brexit event. If my day to pull money out of my portfolio to pay my bills for the next month is the day after the market corrects 5%, am I not still experiencing sequence risk?
And that goes back to what you said before. That's dollar cost averaging in reverse. So sure, you know, it's the day the money comes out. And if you pick a day and the market happens to be down that day, yes, there's short-term sequence risk.
Well, Ralph, I know that you and your team at ASC Financial Group can help people review and evaluate their retirement readiness and their retirement portfolio to make sure that they are in the best position. Can you highlight a number of the items that you'll help people address, and including sequence risk? How can somebody know if their portfolio might contain elements that would expose them to sequence risk?
Well, one of the things we do, Peter, is what's called a stress test, where we take somebody's portfolio and we'll stress it, particularly through the downturns, like the 2008 scenario that it happened then, and take a look and see the amount of risk that they're taking and the amount of money that could be lost with their current positions if '08 repeats again. So that would be one thing we can do, is an analysis of their current plan. And then we add to that and take a look at, well, what are the fees? Many people come to see us and they have no idea what they're paying in fees. We believe that's something you need to know. Everyone is going to charge a fee, but at the end of the day, you need to know what that fee is. And what am I getting for that fee? And so that's another aspect of this evaluation. It'll disclose what the fees are that someone is paying on their current plan. You know, I had a couple that came in to see me not long ago. They sat down and they sent me their statement. And I said to them, would you be surprised to learn that you're probably paying, I think in their account they had about $100,000. And I said, would you be surprised to know that you're paying about $2,000 a year in fees? And they said, no, there's no way. Here's our statement. Doesn't show anything about fees. So what we did, Peter, is we actually went right to the source. We called the company that had the account, and we got a customer service gal on the phone, and we asked her, what are the fees? It's knowing what questions to ask. And so we said, what are the fees? And I was wrong. They weren't paying $2,000 a year. They were paying $4,000 a year. And so obviously the gentleman, the husband, was quite irate. He started yelling at the poor gal on the phone. We had the speakerphone in my conference room, and I can't believe that you people can do this. I have a statement, and nowhere on this statement does it say I'm paying $4,000 a year in fees. You know what her answer to him was? It's in the prospectus. Has anybody ever read that document? Yes, the fees will be in there, but then nobody ever takes the time to read a prospectus. And so we need to evaluate those fees, because look at Peter, if I'm being told that I'm getting a 7% return and I'm paying a 3% fee, well, I didn't really get 7%, I got 4%. Yet, if I've got a negative 7% and I paid that fee, I'm really losing 10%. So fees not only reduce our gain, they compound our losses. And that's why we need to know how much we're paying. What are those fees? So that would be the second issue that we could do for someone, is evaluate what the fee structure is of their plan and evaluate the risk factor of their plan. And two critical components.
And Ralph, are you finding that that's a pretty common occurrence, that people are surprised by the amount of risk and fees that are in their portfolios?
Amazingly enough, Peter, it probably happens 90% of the time. It's a real eye-opener most people are not aware of. And this isn't just necessarily a fee to an advisor. This might be a fee to the management of the account. So all these fees need to be taken a look at and evaluated.
Well, folks, if you would like that complimentary review and evaluation to assess the amount of risk that is inherent in your investments and in your retirement portfolio that could affect your ability to create retirement income, as well as the amount of fees that you are paying, are you getting what you are paying for? How much are you paying for the advice that you're receiving and the investments that advice is telling you to be in? You need to know these important factors, because it can affect your bottom line. Pick up the phone and give a call to the team at ASC Financial Group, a retirement built to last. Ralph Grauso, Josiah Grauso, and the team will help expose the risks that are inherent in your portfolio, as well as the fees that you are paying, and see if there are ways that you can improve those. Again, for that complimentary review and evaluation, all you have to do is pick up the phone right now and give a call, 800-939-8633. Again, that number, 800-939-8633. And Ralph, since fees are coming out, as you pointed out, whether our performance is positive or negative, whether our account is up or down, as well as RMDs must be taken out of certain types of accounts, required distributions. These two factors are also compounding on sequence risk, aren't they?
Here's what's happening, Peter. You know, if I've got an IRA and I'm retiring at 66, I'm not required to take that distribution till I'm 70 and a half. And when I'm turning 70 and a half, I'm required to take that out, whether I need the money or not. And here again, when I make that distribution, if it happens to be on a down day, I've got sequence risk. You know, again, if that IRA is in a variable account, we're going to have sequence risk along the way. So it does compound the problem with RMDs. In addition to that, it also can create a higher tax liability. And that's the third component of what we'd like to take a look at when folks come to see us is not only has the risk of the plan affect me and the fees affect me, but how is this plan from a tax point of view? One of the biggest expenses of a retirement plan is going to be the tax implication. So we need to evaluate taxes also.
Once you get to retirement, folks, you want to reduce the taxes. You want to reduce your fees. You want to reduce your risk to your standard of living. Therefore, reducing the risk, the fees, and the taxes to your portfolio helps you achieve that. And those are things that the team from ASC Financial Group, a retirement built to last, they can help you review and assess and, where possible, make improvements in those factors. So pick up the phone for that complimentary, free of charge review and evaluation. 800-939-8633 is the number to call. 800-939-8633. And Ralph, what's striking me as we are discussing sequence risk here is how Wall Street's model fundamentally does not address this and why it's flawed for retirement. Because Wall Street has promoted this 4% rule, and if you take 4%, you should be able to cover up to 30 years of retirement. But they say that's a maybe, that's a if, that's a probably, and that percentage has actually come down in many studies that I have seen recently. Here is the fundamental problem that I see with the 4% rule, aside from the fact that it does cause inherent sequence risk, is that my bills do not represent a percentage of my portfolio value. So if my assets are at risk and we experience another 2001 or 2002 or 2008, I can no longer afford to only take 4% out of my portfolio because my portfolio has gone down, yet my bills had stayed the same. I must take an even larger percentage. And Ralph, that is going to devastate my portfolio because of the effects of sequence risk, isn't it?
You have to understand that the 4% rule came into effect back in the 90s. And if you remember back then, the stock markets were going up every day, every year. We had a great run in the stock market over the last 15 or so years. New studies are showing us that there's a probability of a 28% failure rate of this 4% rule. So I don't know about you, Peter, but if I go on a plane and there's a 28% chance this plane is going to crash, I don't think I'm getting on the plane.
And it's also why demographically, the number one category of people newly entering poverty is senior citizens, because what they have been told and what they have been instructed to do from Wall Street on how to handle their money in retirement is fundamentally flawed. And that's what the book Income Allocation was written about. Pick up the phone and give a call. He's offered that book to anybody who calls into the program today over the age of 50. If you would like to receive a copy of the book Income Allocation, pick up your phone and give a call. 800-939-8633. Folks, if you would like that complimentary review, that second opinion, that analysis of your portfolio, again, Northern Pennsylvania, the Lehigh Valley, the Poconos, ASC Financial Group, a retirement built to last. Ralph and Josiah Grauso, they are your local income allocation coaches. Not only have they made the book available, but they have made it available to you for that complimentary review and evaluation. 800-939-8633. Again, that number, 800-939-8633, or just text ASC to 555-888. Ralph, we always appreciate your time and sharing it with us here on the program.
Peter, once again, it was great to be with you.
We'll look forward to talking with you again next week on Your Game Plan for Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.